Hey, good morning. I wanted to come to you with some information on the Trump announcement that he's going to buy $200 billion using Fannie Mae and Freddie Mac, buying mortgage-backed securities. Now, I want to go over some of the data. So if you have clients reaching out to you, you know how to answer these questions and you have some data behind it. So Trump announced $200 billion bid to lower mortgage rates. Now, they want to buy these mortgage-backed securities. The challenge is, so I started digging into some of the figures here. And if we actually look at the what it did first on Friday, 10-year Treasury really was pretty flat. Mortgage-backed security market moved a little bit, but I think that's just a little bit of just based on the excitement around the news. But here's the crazy thing. So the cash equivalents right now, as of end of 2025, most recent balance sheet, was only about $4 billion. They have other money tied up in other areas, but it's already spoken for. So they don't just have $200 billion between Fannie Mae and Freddie Mac. And I pulled up, this is Freddie Mac. I pulled up Fannie Mae's balance sheet as well. And their balance sheet wasn't much better. Their cash is only $12 billion. So how are they going to come up with the money to make this happen? Now, the way they're going to do it is I found this graphic and I thought this was really a cool way to do it and look at it. So what's going to happen is the White House is actually going to direct Fannie Mae and Freddie Mac to make the purchases. So that's happening right now. The issue, again, they don't have the funding. So if they don't have the actual money in the bank to make this happen, then how are they going to actually print the money, right? So it'll take a couple weeks to actually issue bonds to create the money to buy. So they're going to create debt to buy the bonds, basically. And then, so that's going to take a few weeks to do that. And then they're going to generate the cash pool and then actually buy the mortgage-backed securities here. So the purchase is going to take a little while to actually happen. So what we're going to be looking at is the timeline on this is going to take a little bit of time to play out. So it's going to probably take a few weeks to play out, and then it's going to start having this opportunity where we're going to be able to buy, they're going to be buying mortgage-backed securities. As it takes a little bit of time, rates aren't going to really change too much. And then we're going to see this improvement in rates, possibly, and then we're going to see a pop-up of purchases and leveling out. When we talk about the amount of purchases they're buying, it's a fairly small dent in the overall pool of mortgage-backed securities, and it's all at once. Right now, Treasury is actually selling mortgage-backed securities around $35 billion a month. Trump and the administration wants to go in and buy mortgage-backed securities, helping interest rates while they're selling off the mortgage-backed securities from the Treasury. All of this sounds really good, on the news, but what it's going to actually do is, first, it's going to be good overall because it's going to spur activity. So use this as a talking point. Yes, get prepared, get ready to take that advantage of that opportunity that may come in the next 2 months, 1 month, depending on when they free up the cash. Use this as a talking point that, yeah, rates are coming down. Rates have already come down from the 7% range 6 months ago down into the low 6. It may actually not move the market as much as people are thinking, and it's going to be a small dent in the overall pie, because if they're printing more money and inflation's not under control, then what's going to happen when they realize this is actually inflationary and not necessarily good for the overall projection of rates coming down? If they're going to print more money and put more money in the system, and now we have a problem because we just created the issue of why we have higher rates. We actually have higher rates because of inflation. So if we create more inflation, we're going to have possibly higher rates, right? Or not lower rates. So if we put more money into the system now, yes, the lower rates are great. Affordability has already come down. Prices have moderated, rates have moderated, and I'll be doing the market update for January that'll talk a little bit more about that in this next week. But affordability is good. Now they're trying to keep these rates down because lowering the Fed funds rate didn't really impact the rates as much as they probably hoped, because rates are still staying in that that low 6 range, which in general is a positive thing. But we've seen a moderation and kind of balancing out of the market overall. So I wanted to get ahead of this, give you some insight and in timelines on these. So we're in January right now. This purchase hit the market in the next maybe 6 weeks or so. The challenge though is it's already announced. So usually what happens is when the news is announced, this happens. When it actually happens, it actually is less of an actual impact because it's already built in to the market ahead of time. Now, if they don't do it, that could be a bigger problem than if they just do the plan and they execute on what they're looking at doing. So thanks for watching. Have a great weekend. If you have any questions on this, let me know. Let's talk through it. Let's talk about how to talk to clients about it. If you're a client watching this, if you have any questions on interest rates, definitely keep watching our videos or comment below or DM me, and I'll be happy to help. Have a good day.